I have been getting so many messages from you guys lately, literally saying, "Mujina journal entries for video chahiye with GST paid." And honestly, I completely get it. Are you having trouble remembering your standard accounting entries the second the taxes enter the picture? You learn the golden rules of accounting, you have your basic debits and credits down, and then bam, a real-world transaction hits your desk. Suddenly there are input taxes, output taxes, state taxes, central taxes, and it can kind of feel like a totally different language. But don't worry, because today we're going to fix all of that.
So, welcome to today's explainer. We are going to bridge that annoying gap between textbook theory and practical real-world application to really help you master GST journal entries. My ultimate goal here is to make sure that by the time we finish up this explainer, you're going to know exactly how to handle GST in your books with total confidence. Here is our roadmap for today, stepping up the complexity as we go. First, the basics of input GST. Second, GST on purchase returns. Third, outstanding bills with GST. And finally, mixed use and drawings. All right, let's dive right into Section 1, Basics of Input GST for Intrastate Purchases. Okay, let's start with the basic rule for recording the purchase of goods. An intrastate purchase simply means the goods or services are rendered within your own home state. Back in the pre-GST days, it was a piece of cake. You just debit purchases and credit cash. But when you buy something now and pay GST on it, that tax isn't just a vanishing expense. It actually becomes an input. Think of it as an asset that you can often claim against the tax you'll collect later on. Right. So on a normal, tax-free day, purchasing inventory for cash is simply debiting your purchase account and crediting your cash account. Simple, right? But we live in a GST world now, so the entry expands. You still debit purchases for the actual value of the goods, and you still credit cash for the total amount leaving your pocket. But right there in the middle, you have to account for the tax you just paid. And here is how that works. For an intrastate purchase, that tax gets sliced right down the middle. The total input GST is divided equally. Exactly 50% goes to the central government as CGST, and the other 50% goes to the state government as SGST. So you aren't just debiting one massive tax account, you're debiting two separate accounts, input CGST and input SGST, each carrying half of that total tax burden. Moving right along to Section 2, GST on purchase returns and how we reverse those tax benefits. Because, let's be real, things break. What actually happens when those goods you bought are defective and you have to send them back? In a normal scenario, without GST, you just return the goods and get your money back. Debit cash, credit purchase return. Done. But with GST in the mix, the entry gets noticeably longer. If you think about the logic here, it actually makes perfect sense. When you originally bought the goods, you claimed that input GST as a benefit, right? It was a debit. But now that you're giving the goods back, you don't get to keep that tax benefit. You literally have to reverse it. So you credit the input CGST and input SGST accounts to cancel out the tax you originally claimed, right alongside crediting the purchase return account for the actual value of the goods. It is all about balancing the scales. All right, Section 3, Outstanding Bills. Let's look at handling accrued GST. This is where we hit that classic month-end curveball. Receiving a service and getting the bill, but not actually paying it in cash yet. An outstanding bill is a liability. And as we know, liabilities inherently carry a credit balance. Because you haven't paid cash, you obviously can't credit your cash account. Instead, you're recording that you owe someone money. Let's use a telephone bill as an example. The bill is due, but it's not paid yet. Now, telephone services attract GST. You've incurred the business expense and the tax, but absolutely no cash has left your bank account. This requires a compound journal entry, merging the expense, the tax, and that brand new liability all into one single record. So here's how you break it down step by step. Step 1, debit the telephone charges account to record your actual business expense. Step 2, debit both input CGST and input SGST. Listen, just because you haven't paid the bill yet doesn't mean you ignore the input tax asset you're absolutely entitled to claim. And finally, Step 3, credit the outstanding bill account. This officially acknowledges that you owe this total amount in the near future. Finally, we're at Section 4, Mixed Use and Drawings. The classic business versus personal dilemma. You see this happen all the time in small businesses, right? The owner uses the company premises for both business operations and personal living. Now, if rent is strictly for a business purpose, it's easy, rent account to cash.
If company cash is used strictly for personal use, it's drawing to cash, which just represents the owner taking value out of the business. But what happens when a single rent payment covers both?
Well, when those two worlds crash together, with GST added into the mix, things get interesting. You end up with a single payment out of the bank account that has to cover the business's rent, the owner's personal rent, and the GST charged on that entire combined amount.
So this gives us our ultimate compound entry. It's like a puzzle coming together. First, you debit the rent account, but only for the portion that is strictly a business expense. Second, you debit the drawing account for the personal use portion. Third, debit the input CGST and SGST accounts to record the taxes on this rent. And finally, credit cash or bank for the total payment outflow. Doing it this way keeps your business expenses completely isolated from personal expenses, while accurately capturing every rupee spent and tax paid.
Wow. Okay, we have covered a ton of ground today, from basic intrastate purchases all the way up to complex mixed-use scenarios. But the real test of understanding is always application, right? So I want to leave you with a quick brain teaser to chew on. Based on the framework we just laid out for mixed-use rent, what if a business owner bought a laptop with company funds, intending to use it 60% for graphic design work for the business and 40% for their kids to play video games at home? How exactly would you record that entry? And more importantly, how would you handle the input GST on that purchase?